Okay, not one person thought there was going to be a cut today. But when I'm looking at the end of this year into next year, the expectations, the dot plots, are all over the place. Where do you and RBC fall?
Well, we expect the Fed to cut later this year, but look at the balance of shifts in these forecasts. We're going from stagflation light to maybe stagflation moderate, and this is going to be the story for the U.S. economy. Inflation is just slightly too hot for comfort. A 3 handle is a psychological level that matters, and we're coming in below on-trend growth. And all of the news that has happened in the last 2, 4, 6, 8 weeks is going to push us towards even higher inflation forecasts and probably lower growth. That's going to continue to put tension on this dual mandate. So we're going to focus a lot on this SEP and what these forecasts mean. But, Brian, next time they're going to change again, and my expectation is for an even higher inflation number and an even lower growth number.
I'll go back to you quickly, Francis. Why do you think they're going to change again? Why are you so confident in that?
Well, they'll have to. I'm not sure why they say uncertainty has diminished. I wish I was that confident, but we have a series of ongoing shocks that have yet to be felt in this economy. And I think these numbers are still a little bit light on the inflation side and a little bit too strong on the growth side.
David Kelly, would you agree with that the future is fairly cloudy? We don't know what's even going to happen in the Middle East, inflation, energy prices, et cetera.
Yeah, I think it is very cloudy. I will say that since the last meeting, I think some of the tariff uncertainty has diminished. I mean, the tariff rates are not what they were on April 8th. But the thing that strikes me is if you look at that forecast for the end of this year, they think that 4.2% is the right unemployment rate in the long run, and they think they're only going to be 0.3 ahead of that. But they think that 2% inflation is the right number in the long run. It looks like they're going to be more than 1% above that. So, Jay Powell said, if they're both off track, we're going to look at how far they're off track and how quickly they get back to that track. And that suggests that they'll be very reluctant to cut rates until that inflation number comes down.
So, David, back to you. Again, and you nailed it, and I want to hear Jim's thoughts and Steve's and everybody's. When I hear inflation is expected to go up, my little brain immediately goes to higher rates, not lower rates.
No, I think they'll hold rates longer. I mean, I think they could hold rates all the way till the end of the year because I think they know that, look, if this is tariffs, it will fade in 2026. Even if you get a sugar rush from fiscal stimulus from this bill going through Congress, that sugar rush will fade. Sugar rushes do. And so by the end of next year, that's a long way away, but by the end of the next year, the economy should be cooling down, inflation should be cooling down, and maybe then they can give us some lower rates. But right now, do not hold your breath waiting for low rates from the Federal Reserve because they don't seem to have any intention of delivering them.
Jim, Caron, I can't see you right now, but are you holding your breath? I mean, do you think that could we be on hold for longer?
So let me start with the punchline. The punchline is that the Fed did not change their 2025 forecast for policy rates. To me, what that says is that they haven't really changed their position on anything. What has changed is the distributional outcomes, the possibilities, the confidence level that they have in the risks for inflation and employment. So what the Fed is basically saying is that the risks to inflation are skewed to the upside. The risks to unemployment is also skewed to the upside. This is what I think is somewhat being confused as a stagflationary event for markets. This is really about a risk distribution. So if the risk distribution is suggesting that there might be higher inflation and that the unemployment rate might move higher, but they're unwilling to change their policy rate, then really what they're telling you is that the dispersion around what the Fed forecasters has grown. And we've seen that. So you said that we went from 4 people calling for no rate cuts to now 7 people calling for no rate cuts. That's the big news here, is that we're moving towards a no rate cut environment going forward.
Yeah, and Steve Liesman, you've got obviously your Fed survey, so you know what people expect. And looking at it 4 months ago, 3 months ago, 2 months ago, now, and then looking out, are you experiencing that same level, to Francis's point, of sort of uncertainty? And in an uncertain environment, people tend, not always, but often, to do nothing because they don't know what to do.
Yeah, a lot to unpack here. First of all, the Fed survey was spot on, Brian. I'll just point out we were at 390 for this year and 355 for next year. So that really gave people a heads up in that Fed survey of where people thought the Fed might be for 2026. And I agree, there is a massive dispersion around outcomes, but the median official is still on that 3.9 or 2 rate cuts. I think there's good news and bad news here. The first good news is that, well, I'll give you the bad news first. The bad news is the Fed clearly believes inflation is to come from tariffs. They do not believe, at least I guess the median official does not believe, that we're out of the woods on tariffs. The good news on that is they do expect the tariff inflationary impulse to pass through the economy into 2026. And maybe even enough sometime in the second half that there's more clarity that they can eventually cut rates. The point is right now they did not make that movement today. But I think the point that was made earlier is right. They still see themselves going that way. They just ain't in a particular hurry to get there.